And with that, we go straight to our final fireside chat before we're moving into a short break. So our next host doesn't need any introduction, as he is together with his wife Juana, the founder and like the mastermind behind this conference. Vlad Ciurca has been a powerful force and a good friend in the Romanian startup ecosystem. And I'm very glad that he is stepping more into the limelight and hosting this conversation with Tim Jackson about lessons from coaching the CEOs of high growth companies. Please do welcome Vlad and Tim to the stage.
Thanks so much for the intro, Philip. And it's a pleasure to see you here, Tim. We've been talking about having you at Techsylvania for quite a few years, and I'm happy we finally have a chance to do this. I've been following your Medium posts for quite some time, and I think you're talking about a very important topic for founders. And speaking of that, I'm curious, how many CEOs do you currently meet every year, and with how many do you work with right now?
Well, Vlad, it's lovely to be here, and thank you for inviting me again. And I'm very glad that this happened. So obviously, I have to separate two different things here, because I spend 80% of my time as an investor at Walking Ventures, and 20% of my time coaching CEOs. And so obviously, the situation with Walking Ventures is that we have inbound deal flow of about between 1,500 and 2,000 companies a year. We try to keep the deal flow quite small by having very tight focus in terms of stage and geography and sector. And so I meet CEOs in two different capacities, as it were. One is when they're pitching us for funding, and the other is when I'm working with a CEO to coach. And so pre-COVID, I would have told you that I typically meet about 500 CEOs a year, and that's because one of the things that I like to do is meet people over a walk in the park. That's half the explanation for the name Walking Ventures. And so I would typically, pre-COVID, have an 8 o'clock walking meeting and a 9 o'clock walking meeting every weekday. So that comes out to 10 per week, times 50 weeks makes about 500 a year. And that's excluding, obviously, video stuff. Since the pandemic, obviously, I've tried to take that down a little bit. On the coaching side, at any given time, I'm probably working with 10 to a dozen CEOs. And it's fascinating that we have an active portfolio of investments in about 50 companies. And so I get to see a lot of the different things that are challenges facing people when they're trying to grow a business.
Got it. Yeah, you work with quite a lot of CEOs, and I'm sure you, after so many interactions, you can see what are some qualities needed to be a successful CEO. Can you share some of these with the audience?
Well, I think that's definitely right. And it's funny because I was taking a walk with a founder this very morning, and we were talking about the difference between being a CEO when you're just starting and you hire your first 5 people, and what it's like when your company's bigger. And one way to think about it is that, you need a certain amount of persuasiveness to persuade, to get 5 people to quit their day job and come and join you on some crazy journey where you're promising the world. Once you have a team of 25 people, a kind of common structure in a startup is that you've got 5 people who report to you, and each of those 5 people are managing 5 other people. Obviously, it varies by department, so it's not exactly like that. But the key point is what that means is the definition of success for you as a CEO is, can you help those 5 people managing each a team of 5 to do a really good job so that all the people in the company are super productive? And then when you move on, now you're in a situation where you might have, for example, 5 times as many again, 125 people. And now the situation is that you can't just run the business only by force of personality. You have to have some processes in place, you have to have some structure in place. But the risk is you don't want it to become the civil service. You want to stay flexible and stay nimble, but you want to be able to have some processes so that the business continues even if you take a vacation.
That's very true. I'm curious, have you seen there's any specific skills that CEOs need to go from seed stage to Series A and then from Series B to Series C?
Yes, absolutely. And I think, I think of this as a transformation that CEOs have, that founders have to go through. And that if they're not successful, then of course the outcome will typically be that their investors will find a successor CEO who's done it before, who knows how to run the company and has a proven track record in doing that. I like to think of the skills in three different categories. There's stuff which is personal, to do with yourself and how you run your own working life. There's team stuff, which is about you and the people who report to you. And how do you inspire and lead and manage those people that you're directly responsible for? And then more broadly, there's a company piece, which is that there's a load of people that you may not spend an hour with every week, but where your actions and your behavior affect those people. And then in each of those three categories, I think there's the macro and the medium and the micro. So here's to give a couple of examples. An example of something that's very micro and very personal is about time management. A very high proportion of the CEOs that I know wish that they could use their time more effectively. And Vlad, I'm sure you would agree with me that when you look at other founders, what you will see is that some of them just seem to get a lot more done than others. And if you can move yourself into the box of a CEO who gets a lot done in a small amount of time, that's hugely valuable. Now, at the other extreme, something very macro and something to do with the whole company might be about culture, which is that you know that every organization has a certain kind of ethos, a certain way of doing things, a certain taste, a certain style. And as you grow a company quickly, it will evolve a culture whether you think about it or not. And it's actually extremely valuable for founders to think about, what kind of people do I want in this company? What kind of behaviors do I want to see? What kind of attitudes, what kind of interactions do we want to have? And if you are deliberate about that, rather than just saying, well, it'll happen and we'll let it go the way it goes, that can lead to good outcomes. Think about what happens in the opposite direction, by the way. Travis Kalanick, an incredibly intelligent and hardworking guy who was, as you know, an initial seed investor in Uber, took over as CEO. And, he's a kind of bro, like typical American 20-something at the time that he takes over as CEO. And so there's a lot of drinking and there's a lot of fun stuff happening late at night. And for many people, that turned into a toxic atmosphere. I don't think that was done deliberately. I don't think that's what led to his stepping aside as CEO of the business. But I think it perhaps reflects that he didn't have someone to sit down with and reflect on, what am I doing in terms of what kind of culture am I building? And what behaviors should I do differently that might build a different culture?
You touched upon some very important points, and I'm curious, is it fair for startup CEOs to expect their VC investors and board members to support their professional development?
Well, that's a very interesting question, because, of course, as every founder at this conference will know, when you go and see VCs, pretty much every single VC will say, we add huge value. We will support you. Anytime you have a problem, call us 24/7. Here's my mobile number. I believe in having deep relationships with my CEOs. I don't think I've come across any VCs who say, actually, no, we're just dumb money and we'll just write a check and it will be the highest price you get. And so you obviously will expect your VCs to be supportive. And you should expect your VCs to ask you skeptical questions about strategy. Some VCs, by the way, are much more successful than others in sugarcoating the doubts that they have, in making it perhaps not seem intimidating or negative if they have a concern about the business or they think there's a problem. And one of the CEOs I work with, who asked me actually to observe his board meeting with his two lead venture capital investors, it became clear at the board that he had a wonderful relationship with one VC who was very careful to make sure that every time he told him something negative, there were 5 positives first, and another one who just jumped straight in with an honest but nevertheless slightly wounding observation about the state of the business. I think realistically, if you're growing a business, you have to realize that there are skills that you need to build, and it's not really fair to expect your VC to focus a lot of time on your professional development. Strategy, yes. Exit, yes. Deal term negotiation, yes. Use of network, yes. But no, I don't think they can really be your therapist, and I don't think it's really fair to expect them to be your coach.
That's a very interesting perspective. But you said that besides being a VC investor, you also work with your founders as a coach. How is your approach different than any other coaches?
Well, it's interesting that there's a lot of people who have got excellent qualifications in psychology or in organizational things. They'll have PhDs and master's degrees with specialism. I came to coaching via a different route. I came because I was asked by some later stage VCs who had invested in companies that we had done the first professional money in, and who therefore knew about the kind of relationships that I had with founders. And one or two of those later stage VCs said, we've just given $10 million to these guys, and it looks like they're having a problem. Would you meet them for coffee? And so in a way, what I did was I transferred over to the coaching relationships, the kind of relationships that I'd had as an early stage investor. And I guess if I were to sum up one key difference that I see is that a typical coach will come into the session just like a psychiatrist or a psychologist will, asking the question, what caused you to come and see me today? What's the issue on your mind that you're trying to deal with? The way I see it, every smart CEO will have a lot of questions, and most of them will also have a list of people they can call to solve those particular questions. So, for example, if you're dealing with a problem about marketing, you're trying to reduce your CAC, you're trying to find new channels, you will run your finger down the cap table of people who've invested in your business saying, marketing, 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 who knows about marketing? And then you'll find one person and you'll call them and you'll say, I know you're a marketing expert, give me some input on this question. I see my role as coach as often asking the questions that haven't occurred to the CEO. And you remember the famous comment made by the US Defense Secretary Donald Rumsfeld during the Gulf War, where he said there are known unknowns, things you know that you don't know, and there are unknown unknowns, where you're not even aware that you don't know them. And I see that a chunk of the time I spend with CEOs is about helping them discover and resolve those unknown unknowns.
Got it. I'm curious, what kind of differences would you see between Central and Eastern European CEOs? And then from a broader perspective, are there any big differences in mindset between European and US-based CEOs?
Well, I think it's quite interesting. And one way you could think of it is a spectrum going across from west to east as you look at the map. Now, I don't want to make crazy generalizations because human beings are hugely varied and hugely different. But I think I would observe that in Eastern Europe, I see a higher percentage of deep tech engineers who build very unique and very innovative products. And as I see the map moving further west, I see people with greater understanding perhaps of consumer behavior, with greater understanding of marketing and branding, and with greater strengths in terms of talking to investors. Now, if you're one of the people at this conference, you'll be thinking, hey, that doesn't reflect me because I come from this place and I've got those skills. And of course, that's true, that humanity is a mosaic of many different talents and characterizations. But I think that the number of companies that have really become huge in the consumer space have come mostly from China, which is, of course, a unique market of its own, and to a lesser degree from the United States. Whereas there's some spectacular successes from Eastern Europe. Take, for example, Accel's investment in UiPath, which has paid off its early investors spectacularly well, where actually there was some really solid technology there. And the old line people say about if you build a better mousetrap, people will race a path to your door to come and buy it.
Yeah, that's very great to hear. Since there's a lot of founders in the audience, what's some advice you would share for founders that are currently raising money?
Well, I think it's very common to spend a lot of time thinking about the exact words in your slide deck, the colors, the fonts, how you present to people, what your clothing should be, what your tone of voice should be. And those things have some weight, and they probably have more weight with the less experienced and the earlier stage investors. But as you get later and as your company gets stronger, what I think is most powerful is to show real evidence that you have a product that people want. It used to be common for people to commission opinion polls and say, we've asked our potential customers and 82% of them say that if we built it, then they would like to buy it. I've found from experience that those polls tend not to be very reliable. But having an MVP and having evidence of what your customer acquisition cost is and what your funnel looks like and what your channels to market are things that are very powerful in convincing an individual investor. One other thing I would add is I think that I see very few entrepreneurs who actually reach out to too many investors. But I see, by contrast, many entrepreneurs who reach out to too few. And just as if you were hiring somebody, it would be kind of weird to place an ad and get only 5 responses and try and choose between those 5 people. I think likewise, if you're reaching out to investors, then you need to be speaking to a lot more than 5 investors. You need to recognize that there's all kinds of factors that could determine whether an investor is a good fit for your company. Not all of those factors are visible from their website or their portfolio, and therefore you need to reach out to lots of people.
That's great advice. And to finish this off, I'm sure there's also quite a few VCs in the audience. What advice would you give them?
Well, I have many VCs I have many friends in the VC community, and I think there's an awful lot of smart and also very nice people there, which perhaps may be surprising to early stage entrepreneurs who haven't been exposed to venture capital and who mostly know about it from all the horror stories that they've read on the internet. I think what I would say is that venture capital goes in cycles. And if you look at the returns that venture funds make, those returns are surprisingly correlated to the rhythm of public equity markets. And therefore, what I'm seeing now is an incredibly positive, incredibly optimistic time for venture capital, which kind of matches the behavior of public market investors. What I have seen in the past, in the crash of 2007-8 and in the crash of 2000-2001, is that the best returns tend to be made after a significant correction in the market, not at the top of the market. And so most of the VCs I know are under pressure from their limited partners to go out and do as many deals as they possibly can. I would suggest very respectfully that the vintage 2021 deals may not produce the best 10-year return. In terms of the vintage 22 and 23 deals, I'm a great deal more optimistic.
Thanks a lot. You shared so many great insights, and I'm so happy we could do this session. Hopefully next time it's in person. I'd like to
It's been lovely to join you.
Same here. And I'd like to hand it over to Philip if he has any audience questions.
Hey, Tim. Hey, Vlad. Thank you so much. I think that's a great investment advice. I'm definitely looking forward for the vintage 22 and 23. So I'll definitely, if I ever put money into VC, I'll definitely take you up on how to do that well without losing all my money. So very much appreciated. And we do have a question from the audience from Alexandro Oanchia again, is how do you go about investing into a really good product? What's the likelihood that the people building it don't have the connections to grow it faster? Are you bringing in the connection when you decide to invest? So there was a few questions in one big question.
Yes, so there's lots of questions there. So I would start by saying that 10 years ago, like many former entrepreneurs, because I did a startup which I took to an exit which I took to an IPO on the NASDAQ and the London Stock Exchange, and which then exited subsequently. For many former CEOs and former founders, you have a high degree of confidence that you know what will work and what will not work. And what I learned over the past 10 years is that confidence is misplaced. And I no longer aspire to know what products will succeed and what products will not succeed. Instead, I think it's extremely important to focus on evidence of actual customer and user behavior. Now, what I think that means is that it's sometimes difficult when you build a product which might, for example, require a significant network effect, or might, for example, require a regulatory approval. But it's always valuable when you're an entrepreneur to ask yourself the question, what's the smallest thing you can build that will give the greatest visibility about likely use of the product? Now, in terms of entrepreneurs asking investors for help with finding customers, remember, of course, there's two categories here. There's consumer and potentially, SME type products where you're often using mechanized channels to reach out to large numbers of people. And then there's B2B and enterprise products where very often you're targeting an individual or perhaps even a group of people inside a large company that might pay you tens or hundreds or hundreds of thousands of dollars or perhaps even millions. And clearly the approaches for identifying those customers are very different. What I would say is that early on, if you're building an enterprise business, it can take a very long time to get those early customers. One of the investments that's worked out well for us at Walking Ventures is in a security software business called Techsylvania, where I remember having board meetings with the founders in the first year of the company's existence, where essentially every board meeting would be the probability of us closing this first client has gone up from 20% to 30%. That is nowhere near as satisfying to an investor as saying, the MRR has gone up from $20,000 to $30,000 because real money is different from a perception of a percentage probability. But in the end, once you can get the flywheel moving on enterprise clients, it's extremely valuable. What does this mean for you as an entrepreneur? Well, what I'd say is this, that actually many VCs are happy to boast about their black book, the connections they have, the people they can introduce you to. And yet, really the best VCs will be happy to make introductions even before they become an investor. And so as a CEO, you should not be shy when you meet investors. If they start telling you about the people they know who could become your customers, you should not be shy to say to them, okay, could you please introduce us? And the introduction can come before and not after the investment check.
That's great advice. Thanks so much again, Tim.
Cool. Well, guys, thank you so much. I know you need to crack on because you've got lots more exciting things happening this afternoon, but it's great to talk to you and good luck to everybody at Techsylvania.
Thank you.
Thank you, Tim, and thanks, Vlad, for hosting this exciting fireside chat.